Hi, I'm Terry Yan, and I'd like to introduce you to a course that I'll be offering in the fall. The course is entitled Firm Fundamentals and Mispricing. In this class, we're going to explore accounting-based fundamentals that could potentially be used to identify mispriced stocks and predict stock returns. I wanted to show you a little bit about this class. In this class, we're going to review state-of-the-art research and practical tools and frameworks on the optimal use of accounting information for forecasting a firm's profitability and valuing its stock. We'll also discuss evidence that's been documented of market inefficiencies in the use of accounting information for forecasting and valuation. We'll then combine these two streams of evidence to explore the accounting signals that could potentially identify mispriced stocks and predict stock returns. This course is based on the notion that a stock's price is a function of the firm's fundamental value and investor sentiment. What we really like to do is hone in on fundamental value in order to understand how investor sentiment affects the stock price. In assessing fundamental value, we're going to rely on an accounting-based valuation model. In this model, a firm's fundamental value is a function of its current book value plus the present value of expected future return on equities, or ROEs. What we'll do then is we'll examine the analyses and disaggregations that improve forecasts of ROE. For example, we'll look at income statement disaggregations or balance sheet disaggregations that improve forecasts of future ROE. We'll see which disaggregations improve forecasts and when. We'll also look at the disaggregated ratios that combine to get to return on equity and see which disaggregated ratios improve forecasts of future profitability and when. We'll also look at the behavior of ROE over time and the factors that affect that behavior. After we've examined the optimal use of accounting information for forecasting a firm's profitability, we'll consider the cognitive biases and limitations that investors have been documented to have that lead to inefficient use of accounting information. For example, research has documented that investors have limited attention, especially around earnings announcements. They've also documented fixation on certain financial statements or certain line items within financial statements. After we've examined the optimal use of accounting information and the inefficiencies in the market's use of accounting information, we'll explore the accounting signals that could potentially therefore identify mispriced stocks and predict future stock returns. This class is based on the notion that underlies many successful investors, such as Warren Buffett, that says price is what you pay, value is what you get, and behind every stock is an actual company. In terms of course activities, we'll perform hands-on analyses and practical tools through cases, projects, class discussions, and presentations. We'll value very well-known companies, a variety of different companies, and we'll discuss well-known misvaluations of companies. In this class, we're not going to cover specific accounting standards, but rather more general behavior of firm profitability and growth for forecasting and valuation. I hope that the course will demonstrate that accounting is more than just bookkeeping and standards, but rather it can provide important insights for investment decisions. So I hope that you join me for this class in the fall. I think it should be interesting. We should hopefully learn a lot, and I hope that it be relevant not only to your career, but also for personal investing. So I hope to see you in the fall.